I want you to picture a massive, heavy freight train moving at full speed down a track. It is carrying thousands of tons of cargo. The engine is roaring, the wheels are screeching, and the momentum is unstoppable. Now, imagine that far ahead on the track, there is a concrete wall. A wall that was built 10 years ago, brick, by neglect, by underinvestment, and by a fundamental misunderstanding of geology. The train is the global demand for silver. The wall is the geological peak of silver mine supply. And we are currently sitting in the conductor's cabin, watching the gap between the train and the wall close, second by second. I'm recording this from the floor of the Resource Investment Conference in Vancouver. It is January 26, 2026. The mood here is electric, but it is also terrified. For the last decade, the people in this room, the geologists, the mine operators, the financiers, have been warning the world. They have been saying that you cannot starve an industry of capital for 15 years and then expect it to turn on a dime when the price goes up. They have been saying that the silver market is heading for a structural train wreck. And today, as we look at the charts, as we look at the panic in the industrial procurement offices, and as we see silver lurching violently upwards while platinum wakes up and chooses violence, we realize that the warning was not a theory. It was a prophecy. And it is coming true right now. The headline is simple, but the implications are devastating. Global silver mine supply will not exceed the levels we saw in 2016 until at least the year 2030, and possibly much later. Let that sink in. We are 10 years past the peak. We are in the middle of a price explosion. We are in the middle of a green energy revolution that devours silver like oxygen, and yet the mines are producing less metal today than they did when Obama was president. This is the definition of peak silver. It is not that we have run out of silver in the Earth's crust. It is that we have run out of the ability to extract it at the rate the market demands. Today, I am going to take you deep inside the mechanics of this failure. We are going to strip away the paper price and look at the rock. We are going to look at the byproduct curse that handcuffs silver production to the economic cycle of copper and zinc. We are going to walk through the permitting purgatory that makes it impossible to build a new mine in under a decade. We are going to analyze the urgentification of industrial demand, where companies are no longer buying for next month but hoarding for next year. And we are going to talk about what this means for you, the investor, who is holding the only asset that cannot be printed, cannot be hacked, and apparently cannot be mined fast enough to save the system. To understand why 2030 is the earliest possible recovery date, we have to look back at the ghost of 2016. In 2015 and 2016, the mining industry was coming off the highs of the last cycle. They had spent billions on exploration in the early 2010s. Those mines came online, and we hit a global production peak of around 900 million ounces. But then the price crashed. Investors fled. The capital evaporated. For the next 8 years, nobody looked for silver. Nobody built silver mines. The industry went into survival mode. They high-graded their existing mines, which means they dug out the best, richest ore just to stay profitable, leaving the low-grade waste rock behind. This strategy saved them in the short term, but it cannibalized their future. Now those mines are aging. The ore grades are falling. We have to dig up twice as much rock to get the same amount of silver. And because we didn't spend the money on exploration in 2018, 2019, or 2020, there is no pipeline. There are no new mega projects waiting in the wings to replace the dying giants. A mine is not a factory. You cannot just add a night shift. When a mine is depleted, it is gone forever. And finding a new one is like finding a needle in a haystack, except the haystack is under a mountain, and the government won't let you touch the hay. This brings us to the most misunderstood concept in the silver market, the byproduct curse. The casual observer says, silver is at $80. Surely the miners will rush to produce more. This assumes that silver miners exist, but in reality, they mostly don't. Only about 28% of the world's silver comes from primary silver mines. The vast majority, over 70%, comes as a byproduct of lead, zinc, copper, and gold mining. This is the handcuffs. The supply of silver is not determined by the price of silver. It is determined by the global demand for base metals. If the global economy enters a recession and demand for lead and zinc drops, mines will shut down. And when a zinc mine shuts down, the silver that comes out of it disappears from the market, even if the price of silver is skyrocketing. We are seeing this paradox right now. The silver price is screaming, "Give me more metal." But the copper mines in Chile and Peru are struggling with water shortages, labor strikes, and falling ore grades. They are struggling just to maintain their copper output, let alone expand it to feed the silver market. You cannot force a copper mine to produce more silver. Nature put the atoms where she put them. If the ore body has 1 ounce of silver per ton of copper, that is what you get. You can't turn a dial. So we are in a situation where the elasticity of supply, the ability of supply to react to price, is effectively zero. It is broken. The price signal is disconnected from the production lever. Now, let's talk about the time lag. Let's say a geologist leaves this conference in Vancouver today, flies to Mexico, and finds a massive world-class silver deposit tomorrow morning. When does that silver become a coin in your hand? Is it 2027? No. Is it 2028? No. In the current regulatory environment, it takes an average of 10 to 15 years to take a project from discovery to first pour. 10 to 15 years. First, you have to prove the resource. That takes 3 years of drilling. Then you have to do the engineering studies. That takes 2 years. Then you have to get the permits. This is the killer. Environmental impact statements, water rights, indigenous consultations, government approvals. In many jurisdictions, this process alone takes 5 to 7 years. And that is if you don't get sued by an NGO. Then, and only then, do you raise the $1 billion to build the mine. Construction takes another 2 years. So the discovery made today in the heat of the 2026 bull market will not produce an ounce of silver until 2036 or 2037. This is why I can say with absolute confidence that supply will not exceed 2016 levels until 2030. The projects that would be needed to move the needle simply do not exist in the advanced stages. We know what is in the pipeline. We can see the feasibility studies. And the math says the cupboard is bare. We are entering the supply gap, a 5 to 10 year period where demand is accelerating exponentially and supply is mathematically capped. And what about that demand? This is the other side of the vice that is crushing the shorts. We are seeing a phenomenon I call urgentification. For the last 20 years, global industry operated on a just-in-time inventory model. You bought the silver you needed for this week's production, and you trusted that the market would always have more. That trust is broken. The violence we are seeing in the price action, the lunge upward, is the sound of industrial buyers panicking. They are switching from just-in-time to just-in-case. They are realizing that silver is not just a commodity, it is a strategic component. If you are Samsung or Tesla or a solar giant like Jinko Solar, silver is oxygen. You cannot ship your product without it. And if the price goes from $50 to $100, it adds maybe $1 or $2 to the cost of your product. You pass that on to the consumer. But if you run out of silver, your factory stops. Your stock price goes to zero. Your competitors eat you alive. The cost of running out is infinite. The cost of paying up is negligible. This is inelastic demand. We are seeing this play out in the solar sector specifically. The new technology, TOPCon and HJT cells, use significantly more silver than the old PERC cells. The industry is trying to thrift, trying to use copper, trying to reduce the silver paste. But they are hitting the limits of physics. Silver is simply the best conductor. If you want efficiency, and the whole game in solar is efficiency, you need silver. The International Energy Agency knows this. The Chinese Communist Party knows this. That is why China is importing silver at a rate that looks like a black hole. They are draining the London vaults. They are draining the COMEX. They are securing the atoms for the next century of energy dominance. And let's not forget the defense angle. We are living in a dangerous world. Missiles, satellites, fighter jets, drones, they all rely on high-performance electronics. Those electronics rely on silver. You cannot put a copper connector in a Tomahawk missile. It will corrode. It will fail. You need the reliability of silver. Do you think the Pentagon cares if silver is $80 an ounce? Do you think Raytheon cares? No. They care about supply security. We are likely seeing strategic stockpiling by militaries around the world, quietly, in the background, adding another layer of opaque demand to a market that is already tight as a drum. I want to mention platinum here because it was a key takeaway from the conference. Platinum has woken up, it has chosen violence. Why does this matter for silver? Because platinum is the rich man's industrial metal. It has been undervalued for years. The fact that capital is rotating into platinum tells us that the smart money is hunting. They are hunting for scarcity. They are hunting for physical assets that have been beaten down by the paper market. When platinum moves, it confirms the thesis. It tells us that this isn't just a monetary panic. It is a hard asset revaluation. It is the market realizing that we can print money, but we can't print palladium, platinum, or silver. The periodic table is taking its revenge on the printing press. This brings us to the inventory trap. The bears will tell you, there is plenty of silver. Look at all the jewelry in India. Look at grandma's tea set. This is a fallacy. Yes, there is silver above ground, but it is not in the form that the industry needs. A solar factory cannot feed a sterling silver fork into its production line. It needs 0.9999 pure silver grain or bars. To convert the tea set into industrial grain requires refining. Refining is a bottleneck. There are a limited number of major refineries in the world. They are currently running at capacity. If 1 billion ounces of scrap silver suddenly hit the market because the price went to $100, it would create a logjam at the refineries. It would not immediately solve the industrial shortage. It would take months, maybe years, to process that metal. So, total above ground stocks is a meaningless number. The only number that matters is available, refined, deliverable inventory. And that number is dangerously low. Let's talk about the mining stocks. The companies represented in this room in Vancouver. For years, they were the dogs of the market. They were burning cash. They were diluting shareholders. Now at these prices, they are cash flow machines. They are printing money faster than they know what to do with it. Their balance sheets are pristine. They are paying dividends. But, and this is a massive warning, a bull market does not cure incompetence. Just because the price of silver is up does not mean every mining stock is a buy. Many of these companies will still find a way to screw it up. They will make bad acquisitions. They will operate in jurisdictions that decide to nationalize the mines or raise taxes to 90%. We are seeing resource nationalism everywhere. Mexico, Peru, Bolivia. Governments are looking at these high silver prices and licking their chops. They want a bigger piece of the pie. If you are investing in miners, you have to be surgical. You want companies with existing production, because remember, new production is 10 years away. You want companies in safe jurisdictions. You want management teams that treat the company like a business, not a lifestyle. The separation between the winners and the losers in the mining sector will be brutal. The winners will make 10x or 20x. The losers will go to zero because they will lose their license or their assets to a greedy government. But for the physical holder, for you and me, the message is clear. Physical is king. This was the mantra at the conference. Physical is king. In a world of paper derivatives, counterparty risk, and failing supply chains, the only thing that matters is what you can hold. The paper market can trade billions of ounces, but the paper market cannot build a solar panel. Eventually, the paper price must converge with the physical reality. And because the physical reality is constrained by the supply wall of 2016, the price has to do all the work. Economics 101 says that when demand rises and supply is fixed, price must rise. But we are not in Economics 101. We are in a situation where demand is exponential and supply is falling. That means price doesn't just rise, it goes vertical. It has to go high enough to destroy demand. But as we discussed, industrial demand is inelastic. It doesn't want to be destroyed. So the price has to go even higher. It has to go high enough to convince you to sell your stack. It has to go high enough to make it profitable to recycle microscopic amounts of silver from iPhones. We are talking about triple digits. We are talking about a paradigm shift. Let's touch on India. The Indian buyer is the smartest silver buyer in the world. They understand value. The Western investor buys when the price goes up, momentum. The Indian investor usually buys when the price goes down, value. But right now, we are seeing something terrifying for the shorts. India is buying even as the price hits record highs. They are not waiting for the dip. They are chasing the price. This tells us that the psychology in the East has changed. They are no longer viewing silver as just a savings account. They are viewing it as a fleeing asset. They are worried it won't be there tomorrow. When the most price-sensitive buyers in the world stop caring about the price, you know you are in a mania. You know the shortage is real. This is the vacuum sound we are hearing, the sound of metal being sucked out of the West and sent east, never to return. So what does the next 5 years look like? From now until 2030, we will be in the peak silver trenches. The headlines will be about shortages. You will see stories about factories shutting down because they can't get silver. You will see stories about strategic national stockpiles being created. You will see the premiums on physical coins detach completely from the spot price. The mining industry will try to respond. They will drill like crazy. They will announce massive new discoveries. But remember the time lag. Those headlines are just promises. The metal is 10 years away. The market will realize that help is not coming. The cavalry is stuck in permitting purgatory. This realization that the supply response is broken is what drives the super cycle. In past cycles, high prices fixed high prices. The price went up, miners dug more, the price went down. This time, the mechanism is jammed. High prices cannot create more metal in the short term, so high prices will beget higher prices. This brings us to the danger. Volatility. When a market is this tight, it snaps. We will see violent corrections. We will see days where silver drops $10. The banks will try to regain control. They will raise margin requirements. They will try to shake you out. They will try to convince you that the shortage is over. Do not be fooled. Look at the mine production numbers. Until you see global production cross that 2016 line, until you see us producing more than 900 million ounces a year consistently, the structural deficit remains. The fundamentals are locked in for a decade. This is not a trade for the faint of heart. This is a siege. We are besieging the laws of geology. We are waiting for the inevitable repricing that comes when an infinite paper currency meets a finite essential resource. I want you to think about your own position. Are you holding paper? Are you holding an ETF? Or do you hold the king? Do you hold the physical metal? Because when the music stops, when the industrial panic reaches its peak, the paper claims will be settled in cash. You will get your fiat currency back, right as it becomes worthless. The industry will get the metal. The sovereign wealth funds will get the metal. And the physical stacker will get the metal. The gap between 2016 and 2030 is the valley of death for the short sellers. It is the period where their bluff is called. They have been betting that they can always find more silver. They were wrong. The earth has said no. The governments have said no. And now the market is screaming yes. We are witnessing the revenge of the old economy, the revenge of stuff, the revenge of atoms. For too long, the financial world thought it could financialize everything. They thought they could print prosperity. They forgot that you can't eat Bitcoin and you can't build a missile with a derivative. You need the rock. As I leave Vancouver, the snow is falling. But the heat coming off this sector is palpable. The insiders know. The smart money knows. And now, you know. The wall is real. The train is moving. And there are no brakes. This is the reality of peak silver. It is not a theory about the future. It is a description of the present. The mines are tapped out. The new mines are ghost stories. The demand is a monster. So what are you going to do? Are you going to bet on the paper? Or are you going to bet on the rock? I know where I stand. I stand with the geology. I stand with the math. And the math says that 2026, 2027, 2028, these are going to be the years of the silver squeeze. Not a squeeze of days, but a squeeze of years. A structural, grinding, relentless repricing of the most undervalued asset in human history. Stay disciplined. Stay physical. And watch the production numbers. They are the only truth in a market of lies. And right now the truth is that we are running on empty, and the world has just hit the gas pedal. The era of abundance is over. The era of scarcity is here. And in the era of scarcity, he who holds the metal makes the rules. Be the one who makes the rules for your own life. Secure your position, because by the time the supply catches up in 2030, the wealth transfer will already be complete. The train will have already arrived at the station. Make sure you are on board.